Hi, everybody. This is David Skriko. Hope you're doing well. I'm back in Canada. First time in 4 years, but we're going to have an interesting, this is going to be on Sunday. Then I'm going to have another, I guess our theme is going to be debt, which is kind of appropriate being in Canada right now for the next 2 days. So what we're going to talk about now is, because I've seen something the last few days which interests me, the action in the bond market, the corporate bond market. It's a trade I've talked about for years, is that, ever after the Big Short movie came up, I think we've all been looking for, or at least I've been looking for, the next Big Short. And I think I found it actually 5 years ago in 2018 in corporate bonds. I think when you're looking for a Big Short, you want to look for a mispricing of assets, right? So in 2000, it was .com stocks, big tech, internet stocks, etc., right? And then in 2006, 7, it was mortgage-backed securities, home builders, etc. So I think during the last decade, it's been corporate bonds, because even though the stock market is overvalued, what's happened is in this kind of search for yield, because interest rates were really, depressed since early 2011, 2012. Uh, uh, you know, Investors have been diving in for yield. And there was a boom in junk bonds, especially in energy related junk bonds. But really, it's investment grade corporate debt that's the epicenter of that, because people were willing to pay up in price and get meaning less and less yield, just because treasuries were so depressed. They were willing to uh, buy bonds that probably should have been yielding 5 or 6%, that were yielding 3 or 4%. And now we're seeing that adjustment as interest rates go higher. And these companies went on borrowing sprees, as we'll show you. So we're going to quickly show you this here. So this is what we're going to be looking at, shorting the LQD, the investment grade corporate bond ETF, as our kind of vehicle choice to play this. And I've done it off and on in the past. And what I really like about this, again, we're going to talk about the mispricing or risk. We're going to show you an example of this. Is that. So when we look at the corporate debt bubble, this is the corporate bond issuances. And we can see the boom, and it even says here, is in the lower end of investment grade. So you can see that's this kind of dark yellow color here, and then this red color. But notice that how big these expanded. Like this was, a couple hundred billion a year, basically actually more like 100 billion a year during the financial crisis, and it went up to about 400 billion a year. The combination of investment grade, and the lower end and higher end, and that's what we're focusing on for here, right? So that was like the huge expansion. One reason there was a huge expansion in junk rate is that many companies got converted to junk during the financial crisis, and then were forced to do that. And again, people were diving into yield. So the first phase of this was, junk, and then the second phase, which we're concentrated on, was investment grade debt, and that boomed even more in 2020, 2021, because interest rates were near zero post COVID, and people were desperate for yield and were diving into these things. So if we look at the total amount of debt outstanding, you can see here from the St. Louis Fed, this graphic, that we've gone from just a few $1 trillion back in 1990 to nearly 13 trillion at the end of last year. And 10 trillion of that 13 trillion is investment grade. So that's roughly the US economy is 26 trillion right now. So that's roughly 40% of GDP. And you can see, other than, the recession of 2008, 2009, kind of flattened out during the 2000s, and a little dip here during the COVID crisis, we've been on this straight up, a trend. And you can see it's actually doubled since 2010, from 6 trillion to that near 13 trillion. So this is where I think the real epicenter of this is. And by the way, a lot of these corporate bonds aren't like going into the stock market. Like you look at the bonds of IBM, McDonald's, these kind of companies, they're a lot less liquid than say like what those stocks trade on the stock market. So this is where I think the anomaly is, that these corporate bonds, and we're going to look at the historic yields here. Now, this only goes back into the 1990s. And you can see that since the 1990s, the long-term average is 4%. And you can see most of the 2010s, we spent roughly around 3%. I went below 2% in both 2012 and after COVID in 2020. But I would say for the most part, we were around 3%. So we were roughly 25% below the normal average yield. Remember, that brought down the average yield. You can see in the 90s and 2010s, mostly we were between 4 and 6%. So really right now we're back, I would say, to roughly the last 30-year average. And if this chart were to go back, 50, 60 years, you'd probably see about 5 to 6% is closer to the average in investment grade corporate debt, right? So why is that important? Well, that's important because so many of these companies have borrowed money cheaply during this huge boom, as we just showed you, and borrowed at low rates, low coupon rates. And then most of these bonds are 5, 10 years in duration and now have to roll over. So the first part of these rollovers is basically kind of happening now, but we can see the late, it wasn't that yields weren't that depressed in the late 2010s. So I really think when this really starts to hit is in the next 2 years, when a lot of this debt that was issued post-COVID, the 5-year bonds begin to hit, in 2024, 2025, 2026, and then later in the decade, when a lot of the debt that was issued here, the 10-year bonds, say in 2017 or something like that, when they begin to roll over. And we're going to show you McDonald's as an example. And most of these companies can't pay down this debt, and they're going to have to roll it over, and they're going to have to roll it over at much higher yields. And those higher yields then eat into profit margins, and then that can hurt equity prices, et cetera. And what we must remember is the debt levels now are so high in these companies that a lot of the studies have shown that if you had normalized interest rates, which we are starting to get now, like let's say these companies had to roll over these bonds at 5, 6% instead of issuing them at 2, 3%, they themselves would actually become junk because they would become junk because that the debt level is so high and servicing that debt now becomes a lot higher. So now let's look at McDonald's as an example of this. We're going to go, first of all, look at McDonald's income statement and balance sheet. You can see here that McDonald's over the last 4 years has gone from about 21.3 billion in revenue to 23.2 billion. So roughly, an increase of like 1.7, 1.8 billion. It's increase. And actually, McDonald's did not grow for years in revenue, by the way. But anyhow, that's shows their revenue growth. And if we go look at the McDonald's stock price, which we'll look at in a second, we'll get off the LQD here. We'll get back into that later. You can see since 2019, the stock has gone from roughly 180 a share to 290 a share. So it's gone up 60% on a 7% increase in revenues. Now, stock buybacks, that sort of thing, which is inflated EPS, has been all part of that. So, and the ability to borrow cheap and do those stock buybacks is a big reason for that. So now we're going to look at, and what's interesting about McDonald's, this shows you how corporate debt has propped up the valuations. Notice that McDonald's is a $213 billion valuation. Well, McDonald's, we can see here from the revenues, has 23 billion in revenues. So McDonald's is trading at 10 times revenues. That's usually the kind of valuation that is for like an extreme, like fast growing, a growth company, not kind of an older, stable business like McDonald's. Now, one reason it's more difficult to judge McDonald's than say other companies that they're essentially also a real estate holding company. And most of the real estate they hold is the prime real estate, downtown, the cities, et cetera. I know even in the little town where I'm from, it's called Dundas, Ontario, that McDonald's has probably been there for over 50 years. And that, the boom in land here, whatever they paid for that, probably $20,000, $30,000 is probably worth in the millions now. So, of course, that also gives you ability to borrow because you can use that real estate as collateral. But still, at some point, you have to come back to basic valuations, price to sales, et cetera. And there's no reason that a company that's growing at, a few percent a year in revenues should be trading at, 10 times revenues. But again, this ability to borrow cheap, buy back stock, inflate earning EPS, and then, and all that sort of thing has really, really helped McDonald's. So this is how they've been able to do it. This is an example I'm just going to give you an example of one McDonald's bond. And I could do this for a slew of companies. I could go to IBM, I could go to 3M, I could go to Boeing, but I just want to keep this simple and just show you this is kind of a microcosm of what's happened all over the place. So you can see the McDonald's bond, which is now trading at about 96, so a 4% decline since it was first issued. But it was issued here in 2018. You can see there was a big run up during COVID in the bond. The bond ran up 15% in price because yields went lower, and that helped make this bond look more attractive. You can see the coupon is 3.8%. You can see maturity date is in 2028. But you can also see since those highs of almost $117, this has dropped nearly over 20 points in price, nearly 16%, which is a huge move for a bond. And this is the issue now, because 3.8% does not look attractive when a 10-year treasury is at 4%, right? And when McDonald's has to roll over this bond in 5 years, they're going to be paying a lot more than 3.8%. And here's an example of more bonds in McDonald's down here. And we can see that this is another one that matures in 2029. The coupon again was 3.8. The effective yield right now is 5.45. You can see this one in 2026, 3.45. The effective yield is going to be 5.26. Same thing, 2025, 3.12. The effective yield is going to be 5.4. So what we can see is the effective yield. The only one that is lower is this one that's maturing, and this is probably an older bond that was yielded, when interest rates were higher. But we can see that's got a slightly lower yield. But all these other bonds, you can see, are going to be yielding roughly 2% more. And again, that will, and McDonald's, you can see with that revenue base. And one thing also we'll look at McDonald's balance sheet here is that McDonald's has, so that's their income statement. We're going to look at the balance sheet. McDonald's has $48 billion in total debt, $33 billion in net debt. Remember, they have that debt on only $23 billion in revenue. So they cannot essentially service that debt. They are going to have to essentially, roll over that debt, and they're going to have to do it at higher interest, which is going to cut into their profit margins. And again, we go look at their EPS. And McDonald's trades at 31 times earnings. It's not overly cheap, but this, one reason they've been able to grow earnings, say, from that 9 billion to nearly 12 billion, or the EBITDA, sorry, from that 9 billion to the nearly 12 billion, is the reason they've been able to do that is partly because the servicing of this debt is so cheap. So, you can see the interest expense has only gone from 1.1 billion in McDonald's to 1.2 billion, because again, interest is, so cheap. And, and of course that is going to increase. And let's say, I've showed you how those bonds are going to be up, 2 percentage points, which is more like 40%. Well, if all this debt as a whole goes up 40%, that's a $500 million whack in interest right there. And if all these bonds end up doubling or tripling in interest, which could happen as we continue higher, and I believe for the rest of the decade, as rates begin to normalize and as people pay less premium for corporate bonds, again, that will kind of eat into their profit margins. So that's kind of where we get, and this is where we are right now. And so I think at some point McDonald's becomes an excellent short because of this, even though you wouldn't consider it a short. It's not a high growth company that booms and busts, but it's so overvalued now, and it's taken on so much debt that, as this kind of debt bubble explodes, it's a company that becomes very vulnerable. So, but my main short is going to be the LQD, which we'll get back to. So why did I pick the LQD? What have I explained here? That these corporate bonds were trading at abnormally low levels. Again, we go look at they were trading at 2% yields, right? When historically, over the last 30 years, they trade right about where they do now, 4.5% to 5%. And and that was at low inflation. Now we've got much higher inflation, and I think we will continue to have higher inflation for the next 5 to 10 years. So that will mean, in my opinion, that the effective yield has to go even higher. And then you've got that combined with all this debt has to be rolled over, and there'll be more new supply of debt as well. So I think that's where you really find it. So in these lower kind of rated investment grades, I'm not talking about the triple A's, but those double A's, etc. I think those are the companies that are vulnerable. Those are the companies when they have to roll over the debt. Those are the companies with a higher interest payment. They basically have to readjust from being investment grade to almost being junk. And it reminds me of this little scene here in The Big Short when these guys realize, you know what the better shorts are? It's not the AAA rated MBS, it's the double A's, because the double A's or the triple A's you think are garbage. The double A's are really garbage. So we're going to watch this for about 20 seconds, and then I'll get into the actual LQD trade. And also, I'm going to show you also what they talk about the mispricing of risk. Why I believe we got a mispricing of risk in the option market in the LQD.
Or we need a deal that they're not going to refuse. So what can we do? We can the double A tranches. What if we bet against the double A tranches? Who's not going to take that bet? We know that they say they're 95% AAA rated, but in reality, they're more like 25%. Some of them are 0%. We also know that if the bottom tranches fail at over 8%, the upper tranches are affected. They go to 0. I'll bet you right now that those double A's are actually like B's. I rarely ever say these words, but I think Charlie's right.
So yeah, that scene right there kind of shows you like what they're saying, that they're like, they're double A's, but they're really B's. Well, that's why I feel about a lot of these corporate bonds. Like McDonald's is a perfect example. I don't think, if higher interest rates come in, if a recession comes in, they're probably not rated as high as they are, and even more so in probably companies like Boeing, which are economically sensitive. So as I showed you here, obviously these LQD is sensitive to interest rates. When rates went up in 2018 and went down, but it's also, and same thing in 2022, but it's also very sensitive to economic recessions. The 2020 crash, and obviously the short but deep recession during COVID, 28 financial crisis. Look at how this declined. But here's the thing: you can see historically, and if I go back, say almost to when the LQD started trading nearly 20 years ago, you see, historically, they're very stable, and corporate bonds kind of move higher. They don't have a lot of volatility. You can see, especially in these up times. So the option market has also kind of priced that in. So this is the January 2024 puts on the LQDs. You can see the implied volatility is extremely low. Like most stocks have 3 to 4 to 5 times this implied volatility. So if the price declines, let's say the LQDs in a big decline, I don't know if it'll happen this year or next year, you might want to look at the 2025s, which we'll look at in a second, because this is such a long-term orientated trade. But if this thing declines 20 or 30%, the premiums also blow out. So what happens is not only do you get the increase in price in the put options due to the decline in the underlying security in the price of the LQD, those premiums will blow out. So you'll get like 3 to 5x increase in the price of the option just because the premiums have been going higher. So this is a trade which I believe you really probably want to do the leaps in, which is like that's the January of next year. And they're not the most overly liquid securities, so you might have to sit there and wait on the they go in between, like this is 355 to 525, maybe bid 450. So this is for a smaller investor. Obviously a big fund would just have to go out and short the LQD, but this is the type of thing you want to do, and then you could always roll out the trade when you start losing some of that premium in there. But again, the premiums are so low that even if you did get a big short and that abnormal decline in this to say $80, you're talking probably these trading at $40, $50. You're talking about over 10x gain, and a security that's usually relatively pretty stable and have a lot of volatility. Now technically, let's go look at the chart here of the LQD. This could be shaping up as the bear market rally. Now I first, like I said, in 2018 I first got into this trade, and you can see it did decline. Like I think I almost nailed the top. Like I got in right at the beginning of the year in 101, and you can see it declined to 96, 97. I think I got out of most of it. And then in 2019 and 2020, when they were cutting rates, I wasn't that overly interested in the trade. I think we did enter it last year. I sold a little early. I think, again, it was like I was in near the top here and then in the 120s or something. I think this is not even quite accurate on the stock charts. I think probably Yahoo Finance has a more accurate chart. Let's get it up right now, because the issue is I remember shorting these in the 130s. Yeah, you can see, yeah, this is a more accurate chart. So I remember shorting, I think at 134, about the 130s, and then I sold kind of early. I think I sold like in the spring of last year. And then now, and we declined to about 100. We've come back up, and it looks like this could be the little bear market rally, which again, it rolls over. And if you think of it this way, the economy remains strong, interest rates will continue to go higher. That will hurt the LQD. If there's a big bust like 2008 or 2020, the LQD will probably go lower because credit would deteriorate in a recession. So I think it's a really interesting trade. I think the premiums are low, and it's a good way, it's a good simple hedge for an investor to do. Do not have to short all these different stocks, to not have to do this, that. Again, you don't have the volatility of the stock market in this, so you're not going to get totally wiped out if the trade goes against you. So, and like I said, like that mispricing of risk. One reason that the LQD has such low premiums is that, investment grade corporate bonds are usually stable. But if this debt bubble finally gets exposed, they won't be. And I don't know how long it's going to take. Does it happen due to like a recession? Does it happen due to all that debt being rolled over, from 2025 to 2030? I don't know. I'm not smart enough to do it, but I do think this is an excellent way to hedge. It's a great way for the average person to do it, because you can just buy some puts on the LQD or or short it. And because, again, it's not the most volatile security in the world, shorting it will mean that it really can't, it's not going to be like a Tesla or an Nvidia that can go against you huge. So this is my kind of theme. I've been off and on this trade because you never know when these things are going to hit, when the debt bubble will end. But I think this is a real interesting trade. I think that at some point this will be exposed as a mispricing of risk, and at some point you'll get the LQD really tanking. And look, this cannot last forever. Like, nothing lasts forever. You see, since 2002, the LQD, these are just investment grade bonds. Look how much it's up. So how much higher they can go. And remember, this was at essentially zero rates. So that's about as good as it gets for these corporations. So I hope you enjoyed this presentation. I hope it wasn't a little information overload. I'm trying to keep this as simple as possible because, we are dealing with, I know a lot of retail investors. I want to keep it simple for myself, So I hope you enjoyed it. I hope you've learned something. And everybody take care. It's a Sunday here. I'm going to throw this out there on a Sunday. And I do not have a position yet, but I may be looking to add to the LQDs over the next few weeks. Everybody take care.